Well, well, well. Here we are, Chapter 11, homework number 6, the very last homework in managerial finance. It is a bittersweet moment. I know you guys are cheering, you're happy about it, but I'll miss you. Except for you guys going into advanced finance. You make an A in this class or a high B in this class. You might consider taking advanced finance, which is a case class. And we work short cases and we use the concepts that we learn in managerial finance to solve real business situations. So if you like to think on your feet, think critically, and work through problems, that's the class for you. And it's primarily, it's casework. So you get graded based on cases. All right, enough advertising and promotion. Let's look at homework number 6, risk. Question number 1. Do we always use the weighted average cost of capital for the firm to evaluate every project? Why or why not? And the answer is no, we do not always use the average WACC. The WACC that is for the entire firm. Not every project has the same risk. Therefore, we should not use the same cost of capital. Not every project is financed with the same proportions of capital. Therefore, we do not use the same percentage for every project, same percentage of capital. Therefore, the average WACC does not apply. Question 2, so let's illustrate this point. Question 2, we find the WACC for a firm is 10%. The weighted average cost of capital is 10%. One project they are considering is 30% riskier than the average project. What would the K be for this project? The risk-adjusted K adjusted K, or WACC, is equal to the average WACC times 1 plus the beta of the project. Okay? And so, or times the beta of the project. So in this case, the average WACC is 10% times 1 plus 0.3, 30% riskier, equals 13%. If the project was 30% less risky, it would be 10% times 1 minus 0.3, and you would have a WACC, a risk-adjusted WACC of 7%. All right, question 3. We find that the average WACC for a firm is 12%. You're considering a project that is 15% less risky than the average project. What should K be for this project? So let's go ahead and remove that. And so we said it was 12%. So 12% times 1 minus 0.15, okay, which is 12% times 0.85, which is 10.2%, 15% less risky. Okay, define risk aversion. Number 4. Risk aversion is understanding the relationship between risk and return. The more return you desire to earn, the more risk you will have to take on. The only reason to take on more risk is to earn more return. Risk is not to be avoided. Risk is to be understood and managed. That is risk aversion, not risk avoidance. What are the 4 assumptions of the efficient market hypothesis? And it's 5 assumptions. 5 assumptions. First, lots of buyers and sellers. What makes a market a good or efficient market? First, lots of buyers and sellers. Secondly, buyers and sellers are well informed about the market and about issuers of securities. 3, buyers and sellers have the same goal: maximize your profit. 4, no buyers or sellers can significantly affect the market. This is an assumption. And 5, news comes to the market randomly and cannot be accurately predicted on a consistent basis. 6, what are the implications or consequences or conclusions of the efficient market hypothesis? First, current security prices are an equilibrium in the competition among millions of buyers and sellers. These prices reflect everything that is already known about the financial markets and about the issuers. So that's the first implication. 2, security prices react very quickly and usually appropriately to new information. So, security prices do move, but they move in response to new information that is different than what they had thought or anticipated prior to receiving the new information. So an efficient market does not mean prices don't move. It means that information news comes to the market randomly, and if the news, which means we're not sure what the news is going to be and when it's going to happen, if the news is not exactly what we had anticipated or expected, that news is new information that changes our expectations about the financial markets or about the issuers. And those changed expectations cause investors to act, either buying or selling, which causes prices to move. Number 3, almost no investor consistently earns risk-adjusted returns that exceed the market returns. In other words, can an individual consistently outguess the millions of investors who have the same goal and the same information as you do? And the answer is no. Risk-adjusted means if you, let's say the market goes up 10% and you earn 13%. Wow, you have beaten the market. You earned 13%, but the market went up 10%. You were 30% better than the market. But what if you took on 30% more risk than the average investor, or 40% more risk? Have you done anything special by beating the market? And the answer is no. When you factor risk in, you were compensated the way you should have been for taking the additional risk. So, almost no investor consistently earns risk-adjusted returns that exceed the market returns. Risk-adjusted returns are returns that reflect the level of risk that was taken to realize the returns. The idea is to recognize that looking at returns without including risk is an inadequate approach to assessing returns. And lastly, the last question in managerial finance. How do people accept the efficient market hypothesis? Well, there are 4 levels of acceptance. First, complete unacceptance. Technical investors, these are traders who look at, they don't care about financials, they don't care about economics. All they care about is the patterns, the historic patterns of security prices. That's all they look at. Technical investors do not believe in the efficient market hypothesis. They believe you can use past price patterns to anticipate where prices will go in the future. And the data for technicians is not very good. Their returns haven't been any good. Weak form acceptance. A person cannot predict future stock prices by looking at past prices. Well, that is a contradiction to what technical investors believe. Semi-strong form. A person cannot generate excess returns by trading securities after new information is released because prices change so rapidly. So what they're saying is you can have your finger on the button, buy or sell. The new news comes out and you respond by buying or selling. You've missed most of the move already. It happens that fast. Strong form acceptance. Share prices reflect all information, public and private, so that no one can earn excess returns. So, strong form means that no one earns excess returns on a consistent basis. And that is on a risk-adjusted basis, and that is mostly true except for insiders. And inside information, trading on inside information is significant, important information about an issuer or about the markets, like economic data, that people know ahead of time, like government officials or corporate management. Corporate management knows what the numbers, the results for the quarter or the year look like before the announcement is made to the public. Therefore, there are laws that keep these people from trading or from sharing that information with anyone who could trade. It is against the law, but people still do it. And so insiders, data shows that insiders over history have traded illegally and have earned superior returns, but it is illegal to do so. All right, so those are the 4 levels of acceptance, and I would say that in reality, somewhere between weak form and semi-strong form is, closer to semi-strong form, is the reality of the marketplace. That simply looking at past prices won't help you earn a higher return, and that trading after new information is released really doesn't result in consistently high returns. Okay, so if a company beats their expectations and then you buy, that does not mean you're going to consistently outperform the market. All right, we are done. What we're going to do next is I'm going to work. I have a study session that's already been videoed, and I'll take a look at that. And then I've also created 1 or 2 comprehensive problems. And that's what we work on in the study session, but I might do an additional comprehensive problem just to help you along. So you will at least have 1 comprehensive problem to work, which is your study session, and possibly 2. And then we will have a conversation either over Zoom or personally in class, depending on what semester we're in. To go over some of the specifics of the final and to answer any questions. All right, I've thoroughly enjoyed getting to know you. I look forward to having some of you in other classes that I teach: advanced finance, as I mentioned, investments, commercial banking, and insurance. So if you're a finance major, or if you're looking for if you're interested in any of those areas and you have the room in your schedule to take an elective, I hope you'll take one of my classes. It's been a blessing to get to know you, and I wish God's greatest blessings will continue for you and for those whom you love. This is Dr. E signing off. For the last time, peace out, and peace be with you, and shalom. Shalom aleichem. Peace be with you.